Jerome Powell reveals startling plan to save the US economy. Are we on the brink of a financial collapse? Fed Chairman Jerome Powell has unveiled a controversial plan that could make or break America's economic future. In an explosive interview, Powell discussed the Fed's strategy for recovery and the tough choices they're making to keep the economy afloat. But is it enough? The fate of the country hangs in the balance as we navigate the treacherous waters of a post-pandemic world. Will the Fed's actions save us or plunge us into an even deeper crisis? Don't miss a minute of this shocking revelation that will leave you questioning everything you thought you knew about the economy. All eyes were on Jerome Powell as he stepped up to the podium for the recent press conference. What shocking revelations would he reveal about the situation? What led to the demise of Silicon Valley Bank? The world held its breath as Powell shed light on the crisis gripping the nation. According to Powell, Silicon Valley Bank management failed badly. They grew the bank very quickly and exposed it to significant liquidity risk and interest rate risk without hedging that risk. SVB experienced an unprecedented rapid and massive bank run as a large group of connected depositors, primarily tech businesses and startups, withdrew their funds in a very short amount of time. The bank had all its eggs in one basket, buying a tremendous amount of long-term US Treasury bonds that, as interest rates go up, the value of the bonds goes down. The withdrawals forced SVB to sell these bonds prematurely to cover those withdrawals, realizing substantial losses. The bank tried to raise capital to cover its losses, which spooked investors, triggering a big bank run. The SVB management's negligence opened up a Pandora's box of massive interest rate risk, and they didn't even bother to hedge it. But that's just the tip of the iceberg. A concentrated group of depositors exacerbated the issue, turning to their deposits to meet their liquidity needs. And just like that, a tsunami of chaos hit the economy, sending shockwaves throughout the financial markets. The FDIC tried to save the day by closing down the bank, but their deposit insurance only covered a measly $250,000. That left 95% of the deposits unprotected, causing panic and chaos among the depositors. But the feds wouldn't let the system collapse, not on their watch. The Federal Reserve, the US Treasury, and the FDIC announced that they would make all depositors whole, no matter the cost. But why did the Fed have to intervene in the first place? It's because the risk of contagion was too great. If SVB went down, it would drag down their depositors with them, including startups and tech businesses. The interconnectedness of the economy meant that one problem could quickly spiral into many, causing widespread devastation. The Fed's goal was clear: limit the damage and prevent the ripple effects from spreading any further. But the question remains, are there other banks with similar weaknesses lurking in the shadows, waiting to strike? Michael Berry recently posted an image on Twitter that showed Silicon Valley Bank way up on the top right, away from everyone else, indicating that they had huge unrealized losses versus their cash on hand. And at the same time, they had a very high percentage of their deposits uninsured. It is unlikely that this will happen to other banks, as these are not weaknesses that are present throughout the banking system. The main issue here is not just about a few specific banks, but the risk of contagion spreading like wildfire to other banks and the financial markets at large. But fear not, my dear friend, because the Fed is taking decisive action to prevent any further damage to the US economy. You see, the Fed is like a superhero, swooping in to save the day and limit the ripple effects that could potentially wreak havoc on our financial system. They're not just doing this for themselves. Oh no, they're doing it for the greater good of all of us. The Federal Reserve is a force to be reckoned with, taking bold steps to protect the US economy and strengthen public confidence in the banking system. They're like a shield, protecting every depositor's savings from harm's way. As the press conference drew to a close, Jerome Powell finally touched up on the Credit Suisse saga, but his words left much to be desired. He seemed to skirt around the issue, stating that it was not really in his jurisdiction and that the Swiss government was handling it. But what really caught my attention was his mention of the possibility that the Fed may not need to raise rates in the near future to control inflation. This was a shocking turn of events, especially given that inflation was currently at a staggering 6%. This is what he had to say. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy affirming may be appropriate. The dire state of the banks and their hesitancy caused a dreadful tightening of credit. This will inflict immense pressure on the livelihoods of businesses and citizens, leading to a looming decline in inflation without any rate hikes. As the future remains uncertain, Jerome's mind races with thoughts of the Fed's plan moving forward. The initial data suggests an increase in inflation and labor market strength, indicating the need for higher rates. However, the possibility of credit conditions tightening overshadows everything, throwing everything into chaos. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused as always on the incoming data and the evolving outlook, and in particular on our assessment of the actual unexpected effects of credit tightening. But beware, for the unexpected effects of credit tightening loom ominously, threatening to throw everything into a pit of despair. The only hope lies in Jerome's expectations of credit tightening bringing down inflation, allowing the Fed to watch it fall from a safe distance. Yet, should credit tightening prove to be a minor obstacle and inflation continues to rage unchecked, then the Fed will be forced to act, unleashing a relentless wave of rate hikes until inflation is brought under control and stability is restored. Jerome Powell's explanation of the Fed's recovery strategy gives us a glimpse into the complex world of economics and policymaking. As we navigate through uncertain times, the Fed's plan is focused on assessing the evolving outlook and incoming data, particularly in response to unexpected effects of credit tightening. But what does this mean for you? It's important to stay informed and up to date on economic news and trends. Understanding how the Fed's decisions can impact your financial well-being is crucial. So make sure to hit that subscribe button and turn on notifications to stay informed on the latest economic news and updates. And don't forget to leave a comment below with your thoughts and questions. Thank you for watching, and we'll see you in the next video.